Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. Verizon reported earnings this morning, and the results were a little bit mixed. The stock was up early in trading, seems to be flat as the day goes on. But I wanted to dig into these numbers and how to think about Verizon stock long term. To do that, I asked Jason Hall from The Smattering to come on. Jason, how are you doing?
Hey, I'm great. I'm glad we're talking about Verizon because there's some things that are really appealing about it, but I think it's important that people really start peeling back the layers and understand the risks and the opportunities both.
Yeah, and if you're not following Jason on The Smattering, I will put a link to his YouTube channel in the show notes below. Follow Riiv Investing here on YouTube as well. We really appreciate it. So let's go into some of the high-level numbers here for Verizon. Now, to put the company size into context, it's a $165 billion market cap company with $150 billion worth of debt. Those are two things to definitely keep in mind as we talk about Verizon's results. Revenue in the most recent quarter up 3.5% to $35 billion. Gross margin on their services business, I always think this is really interesting, 74%. So we don't think about this as a SaaS kind of a business, but it kind of is from that perspective. As if they can grow the services business, that is really at the end of the day what's going to drive their profitability. So that's something to always keep in mind with the results. From a subscriber standpoint, postpaid net additions were 217,000. If you might remember from the last few quarters, this is what was essentially flat for 3 quarters in a row for Verizon. And if you're a wireless company, you want to keep adding more and more customers, having smartphones or other kind of phones on the network. That's where investors are really questioning, can this company grow long term? It seems like they've at least turned that around for the short term, so 217,000 additions. If you've seen my coverage on Verizon, one of the reasons I'm bullish on this company is actually fixed broadband. That's 5G broadband going to homes and businesses. It's literally a box you plug into the wall and replaces the cable line that comes in to your house or business from the street or fiber, whatever you're using. I've been using it for about a year now. Works pretty well. They had 379,000 additions to that fixed broadband business. And for broadband total, it was 416,000 additions. So that continues to do well. And then the other piece to keep an eye on is capital expenditures. For the full year 2022, $23.1 billion in capital expenditures. But keep in mind, they are building out their 5G network, acquiring spectrum. That has been a huge drain on cash over the last 12 to 18 months. They're expecting that capital expenditure number to decline over the next 2 years to $17 billion in 2024. So freeing up a little bit of cash. Incremental gains, I think, is the way to think about this. They are expecting earnings to keep declining just a little bit. One of the reasons for that is they're going to be paying more in interest on the debt that they have on the balance sheet. So a lot of a balance here. The stock is trading for about 9 times earnings and has a dividend yield over 6%. So that's the advantage, but that also kind of hamstrings Verizon. So what did you think here, Jason?
Yeah, so, a couple of things that are important. I do think that you're right. That CapEx that they're spending on 5G is really important because, first of all, they have to add 5G simply to remain competitive for their existing customers, whether it's devices like smartphones, but also to tap into that growth for opportunities for people that are looking at 5G for other things, like businesses using it for machine-to-machine communication. You have remote devices, people looking to cut the cord that can move to 5G for data in their homes. Like you said, that's really good. But I think investors have to remember that there's going to be a window of time where that CapEx is going to come down before it's going to ramp up again when 6G comes out. However many years before that happens, it's going to happen. Verizon has $150 billion in debt. Luckily, it's well laddered, meaning they don't have like $50 billion that's maturing next year, right? They only have a very little bit that's maturing this year. And then 2024, they have some. But here's the key, Travis, and this is why I think it's really important to understand those debts that are maturing, the interest rates are between like less than 1% up to about 4%. Recapturing those same terms on future debt is going to be very, very challenging to do. And that means cost of debt's going to go up, cost of capital is going to go up. That's going to weigh on those really good margins they get in their services revenue if they're not able to aggressively avoid having to just re-up that debt, right? If they can retire it as they're going along, that can go a long way towards maintaining that dividend and even being able to continue to grow it. Because here's the reality. I remember a couple of years ago writing about Verizon and saying, this is a really compelling company because it's a yield of over 4%. You know, it's a secure dividend. And now it's over 6%, not because they've aggressively grown it, but because the stock price has come down substantially. I don't think the dividend's necessarily at risk, but if they don't do a good job of managing that capital, getting some growth that's going to give them operating leverage and add to their earnings to be able to grow the payout or maintain it while they're still focusing on servicing that debt that's going to become more expensive if they can't start paying it down, then this is a dividend that could be at risk.
Yeah, and that's one thing that I think is going to be interesting for them, because this is a business that is generating a lot of cash. But what do you do with that cash? Right now, they're spending a huge amount of cash on capital expenditures, and then a huge chunk of cash goes back to investors in the form of a dividend. I would actually argue if you were starting fresh from looking at this company from a dividend perspective, from an investment perspective, you would say, let's de-risk the company a little bit and pay down some of that debt. Maybe $50 billion, maybe $100 billion if you want to really get aggressive and give yourself a lot of flexibility. That's going to take years. But as you mentioned, a lot of the investors who own shares of Verizon don't want them to do that. They want them to keep paying out that dividend, maybe incrementally increase it year after year. So the question for them is going to be, is the growth in smartphone connections, in broadband connections, and then maybe the opportunity to bundle, is that going to increase cash flow enough that they can start paying down that debt while maintaining the dividend? I'm hopeful that it is. I think that the opportunity for them to make those improvements is worth the risk, because the downside risk is just that I'm going to collect a 6% dividend for the foreseeable future. But I understand the bear case, and you've made it here. And I think that we've seen some of that play out. It's like a value trap, a classic value trap investment is you get into this case where, hey, it's so cheap. And then it's 5 years from now, 10 years from now, it still looks really cheap, but it just hasn't gone anywhere. So we'll see how they can manage those waters. But incrementally, I do think it was a fairly positive quarter, because it did sort of ease some of the concerns that have been building over the last 9 to 12 months.
The risk profile, I have to say, the risk reward profile has become more attractive. It's just really important that investors need to understand the things that are coming and how that could kind of change the picture a little bit.
Yeah, absolutely. Well, thanks for Jason Hall for joining me. Follow him on the Smattering. Subscribe to Riiv Investing here on YouTube, and we'll see you here next time.